Wealth, as your analyst projected, the Fed says the largest banks remain well capitalized when tested against a hypothetical severe recession scenario. Fed Vice Chairman Randall Quarles saying in his statement the nation's largest banks are significantly stronger than before the crisis and would be well positioned to support the economy even after a severe shock. An indicator of banks' financial strength, or their common equity Tier 1 capital ratio, declined from an actual level of 12.3% to a minimum level of 9.2% in this stressed scenario. Among the big six, Bank of America was the most capitalized during the test, while Goldman came in quite lower, but all banks handily surpassed the minimum of 4.5%. Largely, the results were comparable to previous years, but a change in the banking law meant that only 18 of the largest and most complex firms were tested, almost half as many as last year. The Fed tested a 10% unemployment rate, a decline in the U.S. yield curve, and appreciation of the U.S. dollar. Next Thursday, we'll see part 2 of the test, where the Fed will provide more details about its quantitative results as well as qualitative results, guys.
Leslie, did you get any sense in the guidance and the documentation, the sort of word part of it, of how comfortable Randy Quarles was overall? Very optimistic relative to past years, was he?
I mean, given his public statement in the press release today, he did seem very pleased with the capitalization levels of the banks, especially as they relate to pre-crisis levels, as the Fed, of course, looks ahead to any kind of issues on the horizon as it pertains to a potential recession. It appears that this test adequately tested for those, and all of the banks seem to pass with flying colors, at least given this year's test, Wealth.